Recording in progress.
Perfect. So we are live today with Sacred Account Saturday. It's good to see everyone today. I'm Jerry Fetta, owner, founder, and CEO of Wealth Dynamics. So I want to just give you a quick introduction. We do these courses every Saturday, and the focus of it is the Sacred Account, right? I believe that the Sacred Account is one of the most foundational and pivotal and important pieces of somebody's personal finances. And so when we go over these courses, really that's the focus is how does it work? What do we use it for? What's the strategy? And so today I'm going to be talking about, our FAQs. What are the most frequently asked questions that we're getting about the Sacred Account? And this will be our third and final week. So we've done 2 weeks of these so far. We've got one more set of questions to go through. And really my purpose and my intention with this is as I'm going through the Sacred Account, really to make sure that it makes sense. Right. And I mean that from the standpoint of, as we learn about these things, like we learn about, 1% strategies, that's one of the things that really comes across initially is like it's a new concept, right? It's not something we're used to hearing. And so it takes some time and some repetition for it to really set in and to be like, oh, okay, that makes sense. Right. Now, the viewpoint that I want to challenge is when we hear about, the Sacred Account, I've been using it for years and years and years. I've been sharing it with thousands of people across the United States. And now into Canada as well. And we just actually launched in Puerto Rico too. So we're expanding quite rapidly. But one of the first things that I see with people on the Sacred Account is they're skeptical, which is fine. I'm that way too. When I learn about something new, I'm like, I really want to understand it, right? I really want to believe in it. But I need to see the data first. I need to see the math. I need to ask all the hard questions. But here's the problem. 99% of the time, the skeptical individual was not skeptical with the things they're doing now. Giving their money to a bank. They didn't ask the same questions. They weren't as picky. They weren't as inquisitive. Giving money to Wall Street, right? They weren't trying to figure that out. They just signed up for the 401k and then they just trust that it's going to the right place, right? And so one of the things as you're watching this, whether it's live, whether it's as a replay, is I want to impart to you, like be skeptical, ask all the questions, be very thorough, but apply that to the other stuff too. Don't just apply it to the Sacred Account. Apply that same viewpoint and mindset to your banking and to your Wall Street stuff and to your retirement plans, right? And what you'll see is that is going to lead you to a conclusion on the Sacred Account of, okay, this makes sense. What my conclusion was is when I applied that level of skepticism to banks and Wall Street and the IRS plans, I was like, these don't make sense, right? So I'm going to be going through some great stuff today. Before we get started, I do want to cover a couple of ground rules, things that we cover each and every week. The first one being is I would like for you to have a purpose for being here. Okay. Why are you here? What are you trying to get out of today's webinar? Okay. It can't just be entertainment value. Like there's got to be, okay, I'm trying to solve this problem with my finances, or I have this goal, right? Or, I have this, maybe burning question and I'm trying to get the answer. Okay, so that's the first thing that I want to cover is why are you here? Okay, and then and that purpose is going to be the basis of all the other learning you're going to do. It's very hard to learn for no reason, right? Like if I don't have a reason for learning, like I'm not going to retain information because I don't have anything I'm going to use it for, right? So that's the first thing. The second thing is we want to get rid of the idea that life insurance and the Sacred Account and all the things that we're talking about are difficult. They're hard to understand. They're for the sophisticated, right? We want to be of the mindset that this can be learned, right? I learned it, guys. I grew up in Alaska. I went to Houston High School. There was 62 kids in my graduating class, right? Like these are things that if I can learn it, I didn't have a college degree. I didn't have any formal training in finances. I literally just did what I call pulling the string. I saw a little piece of string sticking out in the financial world and I wondered what's on the other side of it. And I pulled and pulled and pulled until it started to unravel. And at the end of it was, wow, there are things that the wealthy use themselves that the non-wealthy don't use. That's group of services and tools. That's, let's call that group number one. And then there's a group of tools that the wealthy offer to the middle class and the lower class, but they don't actually use themselves. Let's call that group of tools and services number two. I wanted to learn more about the first group. I'm big on do as I do, not as I say, right? Like someone can tell me something, I'm like, great, but I want to see what your actions are. So when I hear Warren Buffett, for example, say, oh, you should invest your money in an S&P 500 index fund and max out your retirement plan. But then I look at what he does for investing and it's none of that stuff. Or he says, never buy gold, never buy silver, never buy precious metals. And I see that he actually got rich off of precious metals. Like he did a deal in the late 90s that made him quite a bit of money with precious metals. I look at those things and I'm like, why is he saying one thing and doing another? I want to do what he does, not what he says. Right? So that has to be a mindset we have, is this can actually be learned. Right? The second one is that we have to get over the idea of, I've heard this before, I know it all. You know, these different things that we want to, you know, kind of write off as this is repetition. I've done it before. Well, guess what? I went to the gym this morning again. I ate food today again. I slept last night again. Right? This is not one and done. Like anything in life that matters, you do it more than one time. It's about repetition and it's about consistency and doing something to build up that long-term result. Learning about finances is one of those things. Now, here's the problem. We were never taught about finances in school. Think about this, guys. This makes no sense. We went to school to get good grades so that we could go to college and get a college degree, so that we could get a job, so that we could earn money, so that we could do things like own a house and own a car and save for retirement and all this great stuff, right? But the very thing we went to school, all these different grades and courses and degrees and things that we went to go learn about, we didn't learn what do you do with the money once you get it. Right? There's a difference between education and marketing. Education is, this is money. This is where it comes from. Here's how you get it. This is what you do with it. Here's what you can do, you know, to build this outcome or that outcome, or here's what the wealthy are doing. Let's look at why they do it. Right? That's education. Marketing is put your money in the 401k, put your money in the 401k, put your money in the 401k, put your money in the 401k. Every single time you turn on the TV, you watch CNBC or a news channel or whatever, how many commercials do you see about Wall Street? It's constant. They even have TV shows now, right? Give your money to the bank, right? The banks are everywhere. It's marketing. They've been marketing over and over and over. And when you say something long enough and loud enough to a large enough population, it becomes true, right? It becomes true. And so people that have never inspected this stuff, they hear it once and they're like, oh, good, I don't have to learn about it now. It's actually a sign of irresponsibility. Like when someone hears something for the second time and it's a turnoff and they're like, oh, I already heard this, it's because they don't want to have to do it. Right? The responsible individual says, yeah, I want to hear it again because I want to get better. I actually have an intention to use this information. Of course, I want to know it, you know, hear it more than once. I want to know it really well. The irresponsible individual says, I heard this once, I've been on one of those, you know, I've went to the seminar, I read the book, I did this, I did that one time, and that's it. I don't want to hear about it. Now it's annoying me because I've heard this before and you're repeating yourself. Right? So we want to remove that. And then lastly, two things is if you have questions, drop those in the chat. Brianna on my team will be fielding questions and messages in the chat today. So Brianna is an endorsed wealth mentor on my team. What that means is that she carries my personal endorsement. I've trained her myself. And so having a meeting with Brianna is going to be the equivalent of having a meeting with me. I don't have the time and bandwidth to meet with everyone myself anymore. We're expanding out. And so we have a team of endorsed wealth mentors that are able to grow within our organization, meet with clients. And essentially, it's going to be a similar experience to, hey, I'm sitting down with Jerry Fetta. This is what Jerry would be teaching you. This is what Jerry would be saying. And I'll tell you the secret answer. Jerry's going to be telling you to follow the blueprint. Right? Jerry is going to be telling you to set up your sacred account. Jerry's going to be telling you to take your next step. Right? There aren't going to be interesting and unusual solutions. It's like, you know, if you sit down with a personal trainer and they tell you anything other than work out more, eat less if you want to lose weight, work out more, eat more if you want to gain muscle, those are kind of the answers. There aren't other ones. There's no magic thing if they're telling you to rub special creams on your belly to get rid of it, or wear special little bands, or, you know, that's not how it works. Right? So if you're getting a message from Brianna today in the chat, whether you're on Facebook, whether you're on Zoom, you can set up a call with her and do a free one-on-one consultation. The second thing is, as usual, I do want to offer you a copy of my book, Blueprint to Financial Freedom. Blueprint to Financial Freedom is the second book I published, actually. I just wrote another one this week, but this is the second book that I've published, and we're not going to cover enough on today's webinar for you to be able to get everything out of just 45 minutes with me, right? So what we're going to be doing is giving away a free copy of the book. If you go to jerryfetta.com/B2F promo, you can get a free copy of the book. You cover your shipping, we'll send the book out to you, right? So if you don't own the book, if you're not yet a client, if you're exploring wealth dynamics, I'll be totally upfront with you. We write books as an entry point because I don't want people who aren't willing to read. Okay, if you can't learn, or you're not able to learn, or you're unwilling to learn, then I don't want that person as a client. Right? I want someone that's inquisitive, that's willing to invest in themselves. There's no shortage of people that I can go help with finances. And so this shows me, hey, I'm willing to take the first step. I'm willing to spend a tiny, literally like a tiny bit of money. You're going to lose this much money in a week and not know where it went, like wasted on Starbucks or whatever. So it's like $8 for shipping or $10 for shipping. You get the book and then the time to actually learn. If you can't spend 3 to 6 hours learning about your finances, then I'm not going to invest in my team spending countless man hours and hundreds of thousands of dollars to staff them to make sure that you're getting through something when you're not willing to actually learn and read. Right? Like there's only so much you can do. So learning is the foundation of all of this. There is no shortcut. There's no way around that. And here's the issue is those that are unwilling to learn, that's what Wall Street and banks are for. Right? Like if you're unwilling to learn, just go to a bank. Just go give your money to Wall Street. It is easier. You won't have to do anything. You will be taken advantage of. They're going to get rich at your expense, all those great things. But don't worry, they'll give you enough of a little sliver that when you turn 60, you have the glimmer of a hope that you'll die before the money runs out sometime in your lifetime, which is what retirement is. Right? If you don't like that and you're like, I want to learn, right? I want to learn and I want to invest the time, right? Then grab the book and do the reading or do courses. Someone mentioned they like audio or video. We do a ton. If you go to our YouTube channel, there's so much audio, video content there. We're going to be doing some more audio books. We have podcasts. The information out there that we provide is endless, right? And so it's the person that shows the willingness to learn and to improve and actually invest in their knowledge of their finances. That's the person I want to work with, right? So if that's you, grab a copy of the book. If you haven't already, go to jerryfetta.com/B2F promo. Right now, what I'm going to do is I'm going to jump into our FAQs today. FAQs are frequently asked questions. So we went through a series of these the last couple of weeks. This is the final segment of FAQs. Next week, we're going to be focused on a new topic for Sacred Account Saturday. But I'm just going to start these out at the top. Now, the Sacred Account, for those of you that are not tracking with it, if this is a new concept, I'm going to quickly sketch it out, right? So there's two different sides to this. We call this the banking quadrant, actually. So I'm going to show you first the banking quadrant. So the banking quadrant is so important, right? Like this is something that everyone should learn and they don't. Okay, so there's basically 4 quadrants with a bank. And the reason I'm bringing a bank up is because this is where most of us put our money as soon as we get it, right? So we deposit our paychecks where we deposit it into a bank. And so our life, whether we realize that or not, revolves around bankers and banks. And so there's 4 groups that are involved in every single bank. Everyone should know this. This is something that if you learn this today and you share this with someone, you can change their life just like that, right? So first things first is it's irrefutable that our lives do revolve around banks. If you get paid by a company, if you get paid by anyone, that money typically is going to first go into a bank, right? That's called a deposit. You deposit money into a checking account. Maybe you transfer it to a savings account, right? That's up to you, but for sure it goes into checking, right? So we already know right off the bat, your job pays you, it goes into your bank account, and then from there you spend it. Now, check this out. When you spend it, what are the number one places you spend money on? If you own a house first, it's probably your mortgage, right? That's with the bank. That's automated. That comes out every month. You probably have a car payment. That's also with the bank, right? Now, even before that, think about when you get paid. Where did the money come from your company that paid you? It came from their bank, right? Now, where did they get it from? If we follow it all the way back to the top of the trail, like where the money was created, we have an entity in our US government called the US Treasury, okay? Their job is to, distribute currency into the economy and to cover the financials for the United States government. And one of those functions is to put money into existence. Right now, they don't create the money. They actually get it from a private bank called the Federal Reserve Bank or the United States Central Bank. Jerome Powell is the one that runs that, right? And so that's a bank. Like from the very get-go, our dollar is created out of thin air by a bank. It's then loaned to the Treasury. Like this private bank loans that money to the Treasury, right? So that's now a loan. We've got borrowers. The Treasury is a borrower. right? The Treasury takes that money and they infuse it into the economy, and then government agencies and businesses, and then eventually Americans and individuals get that dollar and they deposit it into their bank. So the dollar starts with a bank. When it reaches you, it comes from a bank, it goes into your bank, right? Then you pay all your bills, which most of the big ones are bank associated, right? And then you do things like you fund your retirement accounts. Well, Wall Street, in order to offer a retirement account, they have to have their own bank, right? Like in order for me to host an IRA or a 401k, I have to have a couple of different things. I've got to be what's called a plan administrator. I have to be a trustee. I have to be a custodian, and I have to be a fund manager. These are the 4 ones that most of these companies are. So if you're investing at work with Fidelity or Vanguard or American funds, for them to house your cash, they all own their own bank and trust. American funds is called Capital Bank and Trust, right? Like it's a group. Capital Group is the conglomerate, and then there's American funds, and then there's their bank and trust, and there's custodial, there's their third-party administration. They run all of that in-house, right? But they all own their own bank, which means when you put money into Wall Street, you're giving it to a bank again, right? What about when you're just like at Publix, you've got your debit card or your credit card out and you swipe? Okay, every time you do that, the banks take a merchant fee out of it. Again, the bank's getting paid. So it is irrefutable. Every single part of your life revolves around a bank. Okay, now I want you to take a moment and I want you to visualize the skyline in the city you live in. Or if you live near a city, if you're like me and you grew up and you live out in the woods and it's an hour or two to drive to the city, then think about the city you would drive to. I want you to just envision the skyline of that city, right? So I'm thinking about Tampa. Okay, Tampa, Florida. When I think about Tampa, I think about, okay, the tallest buildings. Are they or are they not owned by banks? Think about it. The banks own the skylines. Those are the biggest buildings in your city, right? So think about where you live and think about where they live. So you're depositing all your money to them because you're supposed to, right? And then they're building wealth off of those deposits. And the way that that works is when you deposit that money, the bank is going to pay you what? 0.01% interest on your deposit. Okay, this is for you interest you're earning. A deposit for a bank is actually a debt. They owe that money back to you. Makes sense, right? You put it in, they want it, you want to come take it back out, they better have it. Okay, Silicon Valley Bank is an example. They just collapsed. The reason why, they didn't have the ability to give people back their deposits. Right? So what the banker does is they borrow the deposit, and then they loan it out to another borrower, and they're going to charge a higher rate. They're going to charge maybe 5%, let's say, on a mortgage, right? The banker gets to keep the difference between what he's paying you on his deposit and what he is charging in interest to that borrower. So if you have a mortgage, that's someone else's money that you're borrowing. That's someone else's deposit, right? If you have a credit card and you're paying interest, the interest you pay on that money, that's someone else's deposit. The bank is making the profit. The banker, he makes the spread, the difference between what the borrower is being charged and what the depositor is being paid. Right now, when this happens, he makes profit. Okay, when there's net profit, this flows through to the owners, the shareholders of the bank, in the form of what's called a dividend. Right, this is the actual system. They earn dividends. It's passive money that they make on their investment in the bank. Right? So in real life, most people are only ever going to be a depositor, right? They're going to only be a depositor. They're going to work. They're going to trade their time for money. They're going to deposit their money into the bank, and that's it. And then if they're lucky, if they've got good credit, then the bank will allow them to be a borrower. Think about this. Who is the bank to be like, oh yeah, you're privileged enough to borrow other people's money. We're going to run this transaction. It's not even their dollars they're putting at risk. What makes them so special that they're the one that gets to decide the depositor's money is going to go to this guy? It's not even their money. It's the depositor's money, right? Why doesn't the depositor just get rid of the banker and go directly to this guy? That's my question, right? We'll talk about that at a different time. But this is what happens is the banker does that. He makes the profit spread there. The shareholders get rich, right? The borrower, he might get rich. If he takes this money he borrowed at 5% and he goes and does something smart with it, like maybe he invests it in real estate, right? Then he might get rich also. But the person who is guaranteed to never get rich, the depositor, the person who just puts their money in the banking system, right? So there's the depositor, the borrower. What's the other thing that's happening? If you're a borrower, right? If you borrow for consumer spending, let's say you borrow for your car or your mortgage or your student loan or your debt consolidation loan or your line of credit or whatever it might be, your credit card, you're probably spending that on consumer goods and you're not getting rich. Do you know who is? The bankers and the shareholders that own the bank. When I make a mortgage payment, they make money. When I make a car payment, they make money, right? They're getting wealthy off of me borrowing, taking loans. So if you're on the left side of this thing here, you're the depositor or the borrower, you're probably not the one that's getting the money here. You're probably not the one winning. If you're over here as a banker and a shareholder, you definitely are, right? You're the one making all the money here. So the question becomes, how do we become a banker and a shareholder? And this is where we use the sacred account, right? So with the sacred account, this is going to be very similar to your bank. Okay, so I want you to think with what you already do. I don't want you to think about where you put it. I want you to think about the action you take. What are you actually doing when you get money, when you get paid, right? And I'm going to show you the flow here so that you can see the similarity, but how you can also see this is where you win. So this sets the tone for what is the sacred account and these questions that we have, right? So if you're a depositor, you're still going to put money into a bank. The difference is you're going to put it into your bank. And you're going to set up your bank through a life insurance policy. This is not any kind of life insurance policy. It's a very specific kind. It's called high early cash value dividend paying whole life insurance. That's the specific kind you're going to use. Okay. You have a guaranteed growth rate here. Okay. So your guaranteed growth rate, you're probably going to make on your guaranteed rate a return of, let me just calculate the numbers out here really quick. On the high side, probably right now, 1 to 2% guaranteed net, like after fees and expenses, long range, you're going to make about a 1 to 2% return. And it's also tax-free. Okay, that's another benefit. The actual bank is not tax-free. So let me just ask you this. You can put your money in someone else's bank and they're going to pay you 0.01%. And you're also going to pay taxes on whatever that measly number is. Or you can put money in your own bank. And you're going to make a guaranteed annual rate, long range of about 1 to 2%, no matter what. And you're never going to pay taxes on that money. It's guaranteed against loss. There cannot be a bank run. The reason why, when you put money in someone else's bank, you go to Bank of America or Wells Fargo, they loan your deposits out. When you put money in your own bank, that doesn't happen. The reason why is you now become the banker. I'm going to talk about that in a second. You're now going to be the banker. So the only one that can borrow against your deposit is you. Right? So you have control on, do I want the money there? Do I want to borrow against it? Do I want to loan it out? Like, what do I want to do? You're in control of that, but your money's fully allocated, backed in there. There cannot be a scenario where the insurance company that you set this up with says, oh, we don't have your money because we loaned it to someone else. They don't do that. That's not the business they're in. They're there to just set up the policy correctly, service it so that you can start becoming your own bank. Right? So just apples to apples. I can put it in their bank, make 0.01% while they loan my money out to other people, and I'll pay taxes on the little tiny bit that I make, or I put it in my own bank. I'm going to make 1 to 2% guaranteed against loss, guaranteed growth. Here's the other thing, 150 to 200 year track record of again, no loss and guaranteed gain. Right? Your bank doesn't currently have that. That's part of the problem. This is the track record of you having your own bank versus putting it in their bank. Right? Banks go out of business all the time. I think between the financial crisis and now, I looked online and almost 500 banks have gone under since then. Okay, the insurance companies that we work with, there's only about 5 or 6 of them. They've been around since the Great Depression, the Civil War, prior to that, even in some cases, and they've never gone out of business. They've always paid dividends. They've always guaranteed. They've always made money and never lost money. Right? Not to mention with your bank, you also are going to have a death benefit. Okay, with their bank, you're not. Right? So it's just on the depositing side. Is that not better? I could put it theirs or ours. And let's just use the example of, let's say you own a grocery store and you had a competitor grocery store across the street. Are you going to buy your groceries at your store or their store? Right? Like, sure, you've got to pay for the groceries either way, but which one benefits you, buying it from your competitor or buying it from yourself? Okay, so let's take that same concept. Which one benefits you, depositing your money in someone else's bank or depositing money into your own bank? Not a hard thing to figure out, right? So here's the nice part is you've got the growth, but now you've also become the banker. Okay, you become the banker. This is where the switch really happens. You are allowed to borrow against your own deposit. Okay, in the other bank, you're not. The banker does that. You're not the banker in their bank. The banker is the banker in their bank. In your bank, you're the banker. So you can borrow against your deposit and you can loan that money out to yourself. And then you can do whatever you want to do with it. So I can borrow against my deposit, loan it to myself as a borrower, and then I could pay off debt. I could, purchase a large purchase like a car or a down payment on a house or a full payment on a house. I could invest that money. I could fund my kids' college with that money. I'm the banker. So what does that also mean? It means that I'm going to make the difference between the interest that I pay, interest cost, versus interest charge, just like a bank. Right? So what does that mean? When I borrow, there's a cost of interest, just like the banker has in real life. The banker doesn't take loans for free. He pays interest on those loans. Right? He's going to pay interest in the form of the depositor. And then also oftentimes they'll pay interest to the Federal Reserve as well. Right? That's a totally different story we won't get into, but there's an interest cost. So is the cost of my interest that I'm paying less than the interest that I'm earning when I loan this money out. Okay, now here's where you make your first money as the banker, the difference between your interest cost and the interest you're charging, which means I deposit money in my own bank. I'm making money on my deposit, right? I'm going to borrow against my deposit and loan it to myself. I'm going to charge myself interest. So there's my first profit is what I'm making here guaranteed. My second profit is the interest I'm charging myself. My third profit is I'm now also the borrower. So let's say that I want to take the money that I've loaned to myself and I want to invest in real estate, and I'm going to make 8 to 12% per year on top of that. Right? So let's pretend I'm charging myself 4% interest. Okay, that my cost here is 2%. Right? So I'm charging, my cost to borrow is 2%. I'm charging myself 4%, but my loan over here is making 8 to 12. And I'm making 1 to 2% on my deposit still. Right? And it doesn't have to be investing. I can use this money forever, anything. I'm the borrower. So I could use this to pay off debt. I could finance a truck with it. I could buy a house with it. I could pay for college for my kids. I could buy furniture. I could do whatever I want to do with it. Okay, I'm just using the example of investing in real estate because I think long-term, that's what most of us want to do. We want to invest for passive income. Right? So I'm getting the interest spread here between my interest cost and my interest earned. I'm getting the money on my deposit, plus I'm getting money on how I'm investing that money. Now, here's the best thing. I'm an owner in the insurance company. By having a sacred account, by having a life insurance, I become an owner, an equity partner in this 150 to 200-year-old company. So I'm a shareholder, right? What do shareholders get? Well, when I pay this interest costs and I invest my money and I put it into my deposits, and I shouldn't say invest, when I deposit my money and it goes into the insurance company general account, and I pay my interest cost, all of this flows through as profit. And it's profit in a company that I'm an owner in, and they share that profit to me in the form of a dividend. Okay, so my dividend, like net, typically my compounding annual growth rate here is going to be about 3 to 5%. Part of that's my deposit, right? So my dividend is going to be typically an additional 2 to 3% per year long range on top of my deposit, right? So I'm getting interest on my deposit. I'm getting the spread between the interest that I'm paying to borrow and the interest I'm charging myself. Okay. I'm getting money here on my investment, and then I'm also getting dividend income. Okay. This one and this one are both tax-free. I do not pay taxes on this money. Okay. Now you can do this so first of all, there's not another way to do this. Right? This is the only system of using this. Now, the funny thing about this is if you go Google something called bank-owned life insurance, okay, the #1 owner and purchaser of this exact kind of life insurance are the largest banks in the United States. So not only are they actual banks, borrowing against your deposits, loaning those out to other people, making money on profits as shareholders, being the banker, they're taking a very significant percentage of their profits and their reserves and putting it into this exact kind of life insurance so that they can be the bank twice. That's how much they love being the bank, right? So we can keep feeding that system, or we can say, cool, I'm gonna be my own bank now. right? Now, if you don't have a Sacred account, you can start. The minimum to start, we charge a one-time setup fee of $500. With that, we include a ton of education, value, and training on how do you become your own banker. Like, we can set your bank up for you, but if you don't know how to be a banker, right? It's like me saying we can build a Lamborghini for you. Well, if you don't know how to drive, it's not going to help you very much. In fact, it could injure you. It could cause damage if you don't know how to use it. So we're in the business of setting up banks for people and training them to become their own banker. We provide the education and support there, right? So we charge a one-time fee of $500 to do that. That's the education support service that you're going to get from us to train you to become your own banker. And then we're also going to help you set up your own custom bank. Okay, and the minimum is 10 times your age per month. So if I'm 40, then I could start with $400 a month. Right? If I'm 50, it's $500 a month. If I'm 20, it's $200 a month, right? So that's how easy it is to get started with something like this. But to do that for a lot of average American incomes, like, we've got to stop giving money to the actual bank. We've got to stop giving money to Wall Street. We've got to stop overpaying money to the IRS. That's where we're going to get the capital to fund our own bank. Right? And then once we do that, if you're already a client and you're watching and you've got your first one done, just like any business, once you've got the first one set up and it's working, it's about scale. I'm going to open my second location. That's your second policy. Let me open another one. Let me open another one. Let me open another one. There is no limit to how many policies you can have. The only limit are two things: your income, actually three: your income, your health, and how many people you could insure that you have insurable interest with: family members, business partners, kids, grandkids, brothers, sisters, that type of thing, where you're close and there's financial ties, and the insurance company that we're going to work with would let you put them as an insured, right? So as long as you keep increasing your income, you can keep owning and insuring yourself. If you've maxed out your income, you can own but insure other people. And then as long as you or those people are healthy, there's no issue with it, right? So I talked to a guy last week. He's got over 10 of these now. I talked to another guy a few months back. He's got over 40 of them. Think about 40 different locations of being his own bank. It's not about just set up one. This is a long game. We want to scale and add more and more and more as we go. So if you're a current client, let's look at, okay, cool, the first one's running. It's time to open up another one. It's time to fund the second one, right? Now, I know this was a big lead up, but this now leads into the frequently asked questions. Okay, now we're all, okay, I agree. There is a banking system. Right now I'm using someone else's. I could be using my own. Here's the benefit and the advantage of doing it that way. Here's how I make money as a result. Here's why that's better. What are the FAQs, right? So let's dive into this. Okay, so the first FAQ is on loans. When I borrow, why is interest so high? Right? Why is interest so high? So the interest rate when you borrow, right? The interest rate when you borrow is the company, the insurance company, you're paying interest to borrow from them. Right? So this is where it's slightly different than a normal bank. Okay, slightly different from a normal bank. In a normal bank, right? The normal bank, they're borrowing against deposits. They're paying money in interest to the depositor. In this one, you have your cash value. Okay, the cash value is $1 percentage of your death benefit. You can borrow against cash value. So the insurance company is saying, hey, we're going to give you our money instead of you using your own. The benefit there is your deposit stays in there growing. So if you're earning 3 to 5% compounding annual growth rate, and then you're borrowing, and your net effective interest cost to borrow this money from the insurance company is generally going to be about 1 to 3%. That's your cost. Net effective interest rate, right? NEIR, net effective interest rate. So you have your 3 to 5% you're making here, compounding annual growth rate minus that net effective interest rate. Let's say 4% on this as an average, minus 2% on this as an average, means that you're making a 2% positive spread as a depositor and as a shareholder every time you borrow against your money, right? So the interest rate generally is going to be about 4 to 6% gross. Okay, gross means before we do anything. If we pay the loan off early, that can reduce our cost of interest, right? So we're just saying if you never paid your loan back, depending on the insurance company, it can be anywhere of 4 to 6% gross rate that you're going to pay in interest. Okay, now you would never not pay your loan back. Remember, we said you're the banker. So the banker is going to make sure the borrower pays his loan and pays the loan back with interest. Same rules apply. So if you are the banker and you tell yourself, I'm going to loan you money from my cash value, Now you need to pay me back this much money per month. That's principal and interest. I'm going to take that money that I'm getting from the borrower, which is also myself in this scenario, and pay my policy loan back. Okay, by doing that, I reduce my outstanding principal, right? So if I'm getting charged a 6% gross interest rate on 100K, that means that I'm going to be paying $6,000 in interest if I never pay my loan back, right? But let's say that I pay half my loan back within a year. My principal is going down. My interest is being calculated off of a smaller figure. And so if I'm paying down my loan by half, I'm probably paying 3 to 4% or less. This is before tax deductions. Let's say 3 to 4% interest, right? So 3 to 4% interest means that I'm paying only about 3 to 4 grand in actual interest costs. It's not actually 6K. I'm paying $3,000 to $4,000. Okay, on top of that, I'm going to take this interest, let's call it $3,500 just to split it down the middle, and I'm going to deduct it off my taxes. Okay, I have to be doing this correctly and working with my CPA to do this, right? So let's say that my net effective tax rate is 25%. So I get to deduct this, and so I'm really only paying 75% of the cost of that loan. Okay, so $3,500 in interest minus the $7,500. I'm paying $2,625 in actual interest, right? How much did I initially borrow? I initially borrowed $100,000. Okay, what is $2,600 into $100,000 as a percentage? Well, that means that my actual percentage of interest paid was 2.625%. 2.625%, right? And I went a little higher on the interest and I went a little bit less aggressive on the pay down, right? But let's say that I was making 4% average and my cost was 2.62. I was profitable on that loan, right? Now, here's the thing is when I'm looking at this from the standpoint of borrowing, this gross rate is dependent on the economy, right? So here's the thing is that interest rates on loans are tied to the economy. So when interest rates in the economy come up, interest rates on loans often will come up as well. Now, so do dividends and guaranteed rates on my deposits. When I put money into my account at 1 to 2%, so back in the 1980s, the dividend rate with the insurance companies was like 8, 10, 12% because interest rates were so high in the 1980s. I'm a shareholder in a company. That company does a lot of investing in interest-bearing bonds. And so when they invest in these like, mortgage bonds and treasury bonds and different things that pay them income, private loans, and rates come up, they charge a higher rate as well. They're making more profit. So yeah, they're charging a higher rate on a policy loan, but they're also paying more in dividends and it offsets itself, right? So whenever I hear a client say, why is the interest rate so high? What that tells me is they're not paying their loans down and they don't know the difference between the gross rate and the net effective rate. What are they actually paying after they've paid their principal down and they've deducted it on their taxes, right? So again, you've got to stop thinking as a consumer and start thinking as a banker. A banker doesn't think about how much does it cost me to borrow. They think about what's my spread, right? So if my rate went higher, let's say my rate became 10%, for example. Okay, then when I borrow, I need to charge a higher rate to the borrower, which is me in this case. My dividend needs to come up also, which it will if interest rates come up, and so does my guaranteed interest rate. And then the thing that I do with that money as a borrower needs to be that much more profitable, which it usually would be, right? All of the numbers come up when the interest rate typically comes up. So it kind of solves itself, but again, you have to pay that loan off early. You have to be the banker charging yourself principal and interest and the borrower making sure that that's happening. You're paying it on time. Right. And this is again, guys, why we say the education piece is so important. If I just give you a life insurance policy and say, go be your banker, what you're going to do is you're going to take a loan, you're going to do cool stuff with it, and then you're never going to pay your loan back. And then you're going to come to me and say, hey, it looks like I'm losing money on my loan. What's going on? My interest rate is more than I'm being paid in dividends and in deposit interest. And I don't know what's happening. This doesn't look like a good deal. Well, it's because you didn't pay your loan back. You weren't actually being a banker. Right? You were being a consumer. How do I take a loan and not have to pay it back? That's a consumer. How do I get free stuff? Right? Like you have to work the system, and this is a system, right? So that's the answer on that question. Can I change policy beneficiaries later? So a beneficiary, that's a good question. The beneficiary is who your death benefit will go to when you pass away, right? And so you can change that, right? So if I want to change that to my spouse or my business partner or whoever, that's totally up to me. The one restriction is you cannot make a minor the beneficiary of a life insurance policy. So if you've got a minor, someone that's under the age of 18, you have to have either a trust be the beneficiary, which is a very smart idea, or a guardian. I wouldn't have a guardian do it just because you don't know what that person's going to do. Hopefully you picked a good one. They're going to do the right thing. If you have it set up as a family trust, I think that's much better, but you can change that. Are there any tax consequences if I do not pay my loan back? Okay, so this is a good question, but also a terrible question. Never not pay your loan back. Okay, you are a terrible banker. You suck at your job if you're a banker and you're not getting your loan paid back on your own loan. It's not like it's someone else. It's you. You loaned the money to yourself. Don't be delinquent on your own loan, right? That's the equivalent of saying, oh, I own a gas station, so I get to steal free gas. No, don't steal from your business, right? It costs money. You are a customer of your own business. You are a borrower from your own banker. Pay the price anyone would pay. Pay your loans back. Okay, I'm never going to help someone not pay a loan. Like if someone's like, how do I get out of a loan? You shouldn't have done this in the first place. Like keep yourself in the retail banking world if that's the way that you want to think about it. Right? This is about being a profitable banker. You're running your own bank, so get your loans paid back. Make sure they're paid back with principal and interest and on time. Right? That has to be in. Now, if something happens and I can't pay my loan back, okay, this is like a fail safe. It's not the strategy. It's not the system. It's not how you're supposed to do it. Because you're borrowing against a life insurance policy that has a permanent death benefit that will pay out no matter what, the insurance company doesn't actually require that you pay your loans back ever. They just want you to pay the interest on the loans, right? So if I get in a tight spot and I'm like, hey, I lost my job or something happened, I can't pay my loan back, as long as I can either service the cost of interest on the loan from my income, or I can take more loans to cover the interest for a year if I need to buy myself some time. And there's no tax consequence for that. If I never pay my loan back, when I die, my death benefit will pay out minus that loan that was outstanding. So the insurance company advanced me money on the loan. I have to pay off that debt with them. Then my death benefit will pay out the net number after that loan was paid. Right? So there's no tax benefit or no tax consequence for doing that. But it's not good business. It is the equivalent of robbing from your own gas station, your own grocery store, whatever company. You would still pay the price of a retail consumer. Otherwise, you're stealing from your own business, right? So that's the answer there. Next one, how can I open a business sacred account? So that's a very good question. If you own a company, so the company is going to be the owner of the account. So there's three different parties. There's the owner, there's the insured, there's the beneficiary. So the company is going to be the owner of that account, right? And as the owner of that account, then you have to pick who's going to be the insured. Who is the life we're insuring? It could be your life. It could be a business partner. It could be a key employee. It could be somebody that promises to buy your business if you pass away. That's called a buy-sell agreement. But there has to be insurable interest. The insurance company has to be able to say, oh, okay, it makes sense that there's a life insurance that's going to pay out to that person. Right? Or that person's being insured by the company. That has to be there, right? So what that means is the company owns it. The contributions are going to be based on the company's net income, right? And that's going to be, if you have a big company, you could actually do that as a much higher number. The cool thing is where the company owns sacred accounts, there's a lot of flexibility on what you can use them for. You could use it for a reserve. You could use it for a retirement plan for the employee. You could use it as a pension. You could use it as a way to pay yourself back the compensation when that employee dies. Or you could use it as a way to keep your business flourishing after you're no longer around, where a benefit pays out and it replaces the loss of you to the business. So that's a fantastic idea if you are a business owner. I would say like open your own personal one first, then let's open a company one second. Next one, if I insure my child, can he take over from me and become the owner of his own policy? So that's the first question. So if you are insuring your child, the child cannot own that policy as a minor. So that goes back to, it's either got to be you're the owner and you're doing it for them, or you've got a family trust set up and that family trust is the owner. And with a family trust, don't do the application as the trust. Apply as an individual, then move it to the owner being a trust. It's much easier, right? Or you've got a guardian involved, right? So once the child turns 18, sure, you could give it to them. But if you put it in a family trust, you don't really need to. You could leave it in the trust. They're the beneficiary of it still. And then there's more control over what that money can be used for. The next question here, what happens if the policy owner dies before the insured? Okay, so if you're a policy owner and you die before the insured, it does not nullify the contract. That ownership is going to go to your estate, right? So if I have, this is the importance of having a trust set up. If I have a trust in my family and that trust owns all the assets, including the life insurance, when I die, nothing happens because the trust owns it. So on phase 2 of the Blueprints of Financial Freedom, we start doing estate planning for our clients. This is where we set up something called a revocable living trust. And it's an entity that lives beyond you, and you assign ownership of your assets to that entity. And part of that would be ownership of your sacred account, right? And so that way, if you die before the insured does, obviously the life insurance contract is still in force. The insured is still living. At some point when they pass away, that death benefit will pay out, right? But it's just a matter of who's gonna own that now that you're no longer there. Same thing if I lived in a house and I died before my heirs did, like they would take over ownership of the house, or it would go to my estate, or whatever would happen. So that trust makes it to where it stays within the family trust, and it has to operate by the provisions of the trust. Good. Next question. What riders should I include to optimize my policy performance? So riders are like bells and whistles you can add to an insurance contract, right? So a rider would be like, I buy life insurance. If I add like a paid up additions rider, for example, that's the bell or whistle that I add that gives me really high early cash value. Okay. I could also add like an index rider where I get participation in the upside of the stock market. It's not in the market, but it gets upside participation. That's something that could beef up my growth, right? I could add, additional paid up additions. I could add, maybe term insurance to reduce the cost of my death benefit as a rider. Those are all things that we blend in to optimize performance on a policy. So there's not really like a magic rider you add in where it's like, oh, now all of a sudden you have a better policy. It's more about the blend of the right riders in the right sequence at the right time, done the right way, to make sure the policy is optimal for you as an individual. And everyone's a bit different. So that's part of what our team does is when you apply with us, we go through and we select what's the right company. Okay, what company is going to design a policy that fits your goals? Then we actually design your account, your policy itself. What's the right blend of insurances and riders and bells and whistles to get the best result for what your goal is with that policy? What are different riders' fees? Okay, so riders, some of them have fees, some of them don't. Every carrier is different. You guys would get bored to tears if I just went through a list of all the carriers and all the riders and all the fees. So just know that some of them have fees, some of them don't. An example of one that doesn't is called an enhanced accelerated benefit rider. It allows you to access your death benefit early in the event that you end up in a nursing home, or you've got a critical illness, or you get a doctor's note saying you've got a limited amount of time left to live. You can access your death benefit early for those things, and there's not like a fee to have that rider. Okay, an example of a rider that does have a fee. Some companies have that index market rider, like you have index participation with the stock market. That one often does have a fee, right? And so that's one where you want to make sure you understand, okay, I have the fee involved. That fee maybe is 1% or 2% per year. What's my guarantee if I don't get the participation of the market? What am I going to get paid anyways, minus that fee? And that's my cost, right? So all of them are different. That does get disclosed in your policy contract. And if you're ever working with our team on a design or a setup and you're seeing riders and you want to know the fees, just ask, hey, which riders do I have and what are the fees associated and what do I need to know about them? What happens if I've signed up and no one has called me yet? So if that has happened, that's a flunk on our end. So let me share with you the process. So when you sign up with us as a client, you work with an endorsed wealth mentor or an ambassador introduces you to us, or you sign up online with our team. Regardless of where you came from, the very first step is you should be getting a welcome email from our team saying, hey, congratulations on your account. Here's what the process is going to look like. Right now, once you've gotten that welcome email, our client services department is going to give you an orientation call. They're going to give you a call in person, congratulate you, and set up a scheduled call to just give you a briefing on like what to expect, how things work, answer any questions you have, and make sure you're fully oriented with what's going to happen for your policy. Okay. Next, after that, you're going to get scheduled for a call with our client delivery team, and they're going to get you started with your application. You'll have a call with our underwriting and application department as well. And that section will be, focused on helping fill out the application, designing your illustration, those types of things. So if you've signed up and it's been like crickets in several days, reach out to us, say, hey, I signed up. I haven't heard from anybody yet. Can I get a nudge, right? And just realize that that's happened probably somewhere. Someone got busy and missed an email, or maybe they were a little bit backlogged on something and they dropped the ball. And so we want to make sure that happens quickly. For me as the founder and CEO, it's very important that we deliver service with speed, right? So just know if you're a client and you're not experiencing speed, that's not okay with me. I want to know about that. I want to make sure we fix that. So that's a way. It doesn't happen often, but when it does, or if it does, that's a way that you can help me out just by giving some feedback. Last question, why can't I sign my application if I'm not in the United States? If you're not in the United States, that's just the rules of life insurance. Our life insurance companies are US-based companies. There are anti-money laundering provisions and Patriot Act provisions, anti-terrorism, all this different kind of stuff. So they want to make sure you are a US citizen, you're here in the US when you sign. If you need to do underwriting, that needs to be done in the United States also. Now, it doesn't mean you have to be a citizen necessarily. Like if you aren't one, you just need to have a tax ID number or a valid company in the United States. But even then, you do need to do your medical exam in the United States. And you also do need to sign in the United States, right? So I have a client with a family office in Puerto Rico right now. Puerto Rico is part of the United States. It's a territory, right? But he's going to be going over to the UK for several months. And so we're coordinating with his team right now. Okay, good. Let's make sure that we get it signed, everything done, underwriting done before you go over to the UK, because if you go to the UK, then you're going to miss that window of signing and it's going to take longer, right? So I know that's a lot of information. Those are our FAQs for today. I do see a couple more in the comments. Let me just jump into these. 7 to 10 funding period with the sacred account. You talked about what happens at the end of that funding period. This is something I was wondering from your last podcast recording. Okay, so the Sacred Account Lite, that's the Sacred Account Lite. That's a 7 to 10 year funding period. The purpose and intention behind that is it gives you a higher cash value early to build up reserves or pay off debt. So for that's for someone that has consumer debt. They don't have their 6-month reserves yet, right? And so we would use that initially. Now, you can fund it for 7 to 10 years. After the 7 to 10 years, you cannot put in more money, but you can still borrow against it and do the banking thing and it will still grow. So you just can't do the deposits anymore, but you can still do the being your banker, borrowing, being a shareholder, all of that stuff still applies, right? At that point in time, you probably have other policies opened up that are not light accounts. They're what we call a premium account or an accredited investor account or a business owned account. And so those are ones that are longer term, right? And so if I've done my light account, I've maxed it out. Great, I'm going to now start my second one. I'm going to do that maybe for a longer funding period. Now, the difference between a light account and a premium account, the premium account is more focused on internal rate of return, right? It's longer term, like a premium account, you're funding probably for 20 years or more, right? It's not going to have quite as much high cash value, right? So we're not using it to pay off debt. We're not using it for reserves. We're building our bank. We're building the most profitable banking system we can. So you'll still see, 70, 80% up front. More or less in liquidity, right? You will fund for longer, but that's the main difference between that and a light account. Very good question. Okay, if we can open a policy for our children, can it get passed on to them as their own bank in their own name? So we did cover that. So that one I would just do through the family trust. That would be the handling there. Let's see here. The growth amount was average 3 to 5 in previous years. Have things changed there? So 3 to 5% is still pretty average. Now realize that's going to be a system of in the early years, it's on the lower side. In the later years, it's on the higher side, right? So 3 to 5%, the first year, I might only see like 1% or somewhere like some very small number because it's the first year. Okay, the second year is going to be a little more, and it continues to grow each year. And then into the policy several years, I'm actually making more than 4 and 5. Sometimes I'll see 6s and 7s, but we're just saying from year 1 to year 121, if we take all of it and we do an average out, it's about 3 to 5 on the lifespan. Lauren, starting my sacred account soon, awaiting approval at the moment. That's awesome. There is a bit of a wait period. It takes usually about 6 to 8 weeks. Andrew says, I had mine set up for a couple of years now. I've paid off my car with it. I'm repaying my policy loans. Also, sometimes making POA contributions to increase my pool of borrowable funds. That's awesome. Andrew is a beast, by the way. Where did his comment go? I just lost it. Oh, borrowable funds, saving my sacred account and gold eventually to get a first position HELOC for a home. I need to email Jerry and get into gold leasing as well. Awesome. Send me that email today, Andrew. Lawrence joined Mint Builder. Awesome. Love Mint Builder. Matt Barquez was just on the call today, actually. I saw him pop in for a minute. Can you be the insurable under a business owned policy if you already have a personal? Yes, you can, Crystal. So if you own a business, you can be the insured, even if you own your own policy personally. Okay, guys, good. So that's it. So a couple of things, a couple announcements before we wrap up. So the first one, I'm doing a second webinar today. Okay, a second webinar today. This is going to be at 5 p.m. Eastern time. Okay, 5 p.m. Eastern time. And I'm going to be talking about personal development. Okay, how I run my own personal development in my own life. I just published another book. I don't know if you guys are aware of that or not. But in that book, I talk about some very hard times I went through in the last 6 months, right? Some crazy stuff. And so one of the things that I did to get through those times is some of the things I'm going to cover in that webinar today. Okay, so I believe all of us are very strong. I believe that as individuals, we're spirits, not just bodies and hunks of meat walking around. I think there's more to us than that. So I think everyone has resilience, but we also all go through loss and barriers and obstacles. Right. And so today during this webinar at 5 p.m., I just posted the link in the chat, by the way. I'm going to be sharing with you how I overcame it and the exact tools that I used, because I think they're tools you can use as well. So if you've ever struggled with loss, discouragement, barriers, obstacles, you felt like you did all the right things and you're still not getting the progress you want, or maybe things ended up worse. You did everything right and somehow you're worse than you started. Right. I want to cover that today in this webinar on how to overcome that and really give you an inside look behind the book. Okay, what exactly happened? Like I'm going to be giving some information that's not even in the book. So if you're interested in learning about that, it definitely is a crazy story, if you don't mind me saying. It's something that reading it back, I wrote it and then I was like, holy shit, how did I go through that? How did I survive that myself? Right. So the link is in the comments for that. The second thing is I did announce and release the book, right? So I will go ahead and just give you part of it right now, like a little bit of the story. So in 2022, a fund that I invested in committed fraud. They committed investment fraud, wire fraud. The guy he got caught pretty quickly, but he just got sentenced. It was a plea deal, and it looks like he's going to be potentially going to prison, paying back millions of dollars to investors and paying fines. But altogether, it was about 130 investors, most of them very sophisticated, to the tune of about $25 million that was lost. He defrauded investors out of. And so that impacted me significantly financially. Another fund I was investing in was money in that fund as well. There was some crossover that I didn't know about. And so long story short, my net worth took a hit, right? And so this book talks about the story there and some of my rebuild, but the proceeds from the book are actually going 100% towards funding education and awareness to prevent financial fraud, and then helping people who have been negatively impacted by it. I didn't realize till I started doing research, just in the United States, the FBI, they came out with a statistic showing last year, financial fraud was a $10 billion problem for Americans. Okay, like people were defrauded out of $10 billion last year. It was actually up 183% over the year prior. Okay, I didn't realize how big of a problem it was. And so there I was with my own struggles, feeling bad for myself and realizing like, yeah, that sucks, but this is a widespread thing and it's not really talked about. Right? I'm somebody where I'm not dumb when it comes to investing. I did all of the things that I knew to do and somehow still got defrauded. Somehow still got taken advantage of. And so through that, there's a lot of learning that I did on how to bounce back and improve. And so the book, was written to obviously tell my story, to spread awareness, right, on those materials and like what's happening and how you can start to maybe get educated yourself, how you can prevent losing money, but also, to help the families and the investors that were impacted. That's 130 families that thought they had money that they're not going to have. They were going to retire and weren't going to, right? And then I named the book Man in the Arena because that's a quote from a speech done by Theodore Roosevelt. And I think it relates so well to all of us. If we're on this webinar today, we're in the arena right now. We could have been somewhere else. We could have been playing right now. We could have been hanging out, taking it easy, but instead we're putting in the work and learning. And that's the man or the woman in the arena. And in that speech, he talks about the critic, and he talks about the naysayer, and he talks about the person that laughs when the guy falls down and gets injured, and you know, the struggle. And there's this kind of similar element of when we're working on our blueprints and we're investing and we're growing our incomes and we're saving, that's a risk, right? There are people out there that they want to see us fail. There are people out that will directly make us fail, like the person that caused this fraud. And then there's also going to be people watching from the sidelines that are critics. Right. And so really, I want to show support to all of you guys that are in the arena, that are putting the work in. And I also want to provide education and protection so that the same thing that happened to me doesn't happen to you. Right. I'm tough. I'm going to build it back bigger, better, and faster than before. But nobody needs to experience that. Okay. I experienced it. That's enough. Nobody else needs to. So that's really the main focus of this. Right. And so we want to solve this $10 billion problem. And it's going to be one person at a time. So all of the proceeds from that new book get donated. If you go to jerryfetta.com/the man in the arena, maybe my team can post that link in the chat as well. You can get the book and then you can start to help out and support. Otherwise, guys, I want to see if you're on the webinar today, every single one of you, I want to see you at 5 p.m. Okay, I want to see you at 5 p.m. That's the Eventbrite link in the chat there. The story I'm going to tell is going to just be unbelievable. So just even for entertainment's sake, to hear a really good story. I love a good story, right? But even better than that, to hear tools, right? When you hear what I overcame and the tools that I used to overcome it, there's nothing you can't overcome with some of the stuff I'm going to share with you. It's guaranteed, right? Like it worked so well for me. So I want to share those same tools with you. So guys, that's all I've got for today. I will be tuning out. I've got a training call to get on. I do want to leave Brianna in charge of the meeting. So if you guys want to stay in and set up an appointment with her, you can. Otherwise, I want to see you all at 5. And I hope you guys have a great afternoon.